Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about mortgage points. And this is something that, because last week we talked about mortgage rates and refinancing, and I'll throw that link in the video right up on the screen here, I did want to talk about another strategy that you are able to leverage if you are reviewing or potentially evaluating a mortgage right now and there are any form of price concessions. So right now, if the home price, which this is the average in the United States, right at $500,000, and the zip code I've selected is an Atlanta area zip code just because I am in Georgia. And this is about the average interest rate that you'll see right now. So with all of that information put into play and my 20% down payment, you can see that the average total monthly payment amount right here is about $3,327 when we're including property tax and homeowner's insurance. And you can see on the amortization basis that over the course of the total loan, you're going to be paying north of $1 million if you were to hold this loan out over 30 years. What I would highlight is if you're in a competitive situation, and we are beginning to see the potential where you're seeing price drops, you're seeing that it is beginning to shift from a buyer's market to seller's market into a buyer's market, depending on your location here in the United States, you may have some options available. So one of those options may be decreasing the price of the home. Now, what you can see right here is my payment amount of $3,327. If we have the opportunity to say we would like to offer them a lower interest rate, or rather a lower rate of $480,000, that drops the payment amount by $150, and you're saving about $4,000 on the down payment amount because you're only putting down 20%. So that means you're only out $96,000 and you're saving about $150 on the monthly payment amount. However, another option that you have available to you is decreasing the interest rate as opposed to the home price. Now, something that I want to showcase is that most individuals are going to be living somewhere for anywhere between 3 to 5 years. So if I'm looking at the amortization on this loan right here, if we are going out to, if we're getting this in October of 2023, and we go out to October of 2029, then you can see that we have paid a total of nearly $200,000 into this loan over a period of 5 years. Or 6 years. So if we're evaluating this loan right here, $200,000, and we still owe $360,000 in this situation. So what I would highlight is one of the advantages or options you have right now is that you can go to the homeowner and you can say, I still want that $200,000 or $20,000 concession, but one of the options I would like to do is for them to pay mortgage points. So one of the things that this does is you have the option that a borrower can pay a mortgage lender, or the buyer could pay the mortgage lender, which is going to reduce that interest rate, which means that you are going to be paying less interest over time. Now, an average point is about 0.25%. So if I paid 1 point, that would drop that 7.78 to about 7.53%. And again, it's going to be about 1% of that home price that you see right there, or the amount that you're getting on the mortgage. So if we were to drop this $20,000 and buy 4 points, that would drop the interest rate here to 6.78%. So you can see that instead of that $150 drop, it's right at about a $225 drop associated with the monthly payment. However, you are going to be out that $4,000 in the down payment that you see here. But keep in mind, when we're looking at the amortization schedule, that last time we were looking at this as of October of 2029, and if we go through that same situation right here, where we're looking at October of 2029, which is super easy to get to, you can see that the loan balance is going to be $10,000 more. So when we're looking at that October 2029, and you're also going to see that the total amount paid instead of that $200,000 right there is going to be closer to about a $187,000, which is about a $13,000 difference over the 5-year term. So what I'm highlighting here is just by buying down the interest rate instead of paying or buying down the home price, what you're doing is you're potentially saving yourself money over the long haul. The question is, as you can see during the AM schedule breakdown below, is at what point does this make sense? So again, right now it's 2023. What if I only go out 2 years? If I go out to the end of October, then I still have $391,000 remaining on this mortgage. However, I have paid quite a bit more in my mortgage rate. Or if I'm starting at $480,000 as our starting point here, and I'm still paying that higher amount in this situation, then what you'll note is that if I go down to, once again, that 2025, my remaining amount on October is $377,000, which is about $15,000 less. So depending on what option you're looking to leverage, you are going to be paying much less on a month-by-month basis if you buy down the rate. But depending on what that price option is going to be dependent upon how much you're saving within each option. So I'm going to link, this is Bankrate's calculator available here on the screen. You're going to be able to see all of the information associated with this. And I think that this is an excellent option to really showcase the value of having different options. But these are some of the things that as the market continues to remain competitive, as you continue to be looking for options in terms of how to get your rate lower or to negotiate to have price drops, you need to be able to have these tools available to see what makes the most sense for you as you're evaluating these different options. So if you have any questions or comments, please let me know in the comment section down below. And if you found this video helpful, please leave a like and subscribe. Thanks. Talk to you later.